Growing up, we might have heard of terminologies like assets and liabilities. Even those who haven't studied commerce might also have a vague idea of what do these words mean. However, for the sake of knowing, we are going to cover these topics in today's video. Assets. Every liability is just an asset in hiding. Mark Victor Hansen. Commonly, assets are considered personal possessions or belongings of an individual that can be sold off to get immediate cash. They can be a house, a car, or even kitchen appliances. A more accurate definition of assets could be certain items or products owned by an individual or a company having considerable amount of value to pay off debts are known as assets. Assets are built over time. Television, sofa sets, mattresses, dressing tables, and even almirais are considered an asset. When building assets, one must consider their resale value. Usually, you do not get paid back the amount of money that you first spent on building the asset. It can mainly be because of depreciation, which is basically the reduction in the original price of the asset from when it was bought first, due to wear and tear. In terms of technology, the price can also be reduced because of the model got outdated and replaced by a new one. Hence, there are certain factors while considering of buying valuable goods. When a firm faces some sort of financial loss, or even if it goes bankrupt, then in the best interest of the company and its employees, the higher management can sell its assets to pay off the company's debt in order to maintain stability to some extent. The assets simply determine the economic value of the company, and whenever the total worth of a company is calculated, its assets are certainly included in it. They do make quite a good portion of the company's total worth. An asset can generate cash flows in the near future. These sort of assets includes all sort of machineries, sewing machines, washing machines, and kitchen appliances, etc. A financial security or a patent. Liability. In business management, liability is the amount of money that a company simply owes to another firm. It normally includes accounts payable, loans, deferred revenue, bonds, warranties, notes payable, accrued expenses, and bank debt. Liabilities are recorded on the right side of the balance sheet. Now some people may ask, why do settled businesses have to buy things on credit? Why do they have to take this unnecessary risk? Well, the simple and concise answer to it is that all sorts of businesses must take on liabilities in order to operate and grow. Without having the assistance of other firms, your company's growth will be on a halt, and your business will simply not flourish enough for you to meet the company's expenses. This will result in taking huge financial loans, and the company being slowly inching towards default. To simply put it into perspective, liabilities are an essential facet of a firm because it greatly helps in exercising more business activities, finance operations, and pay for large expansions. Buying things on credit isn't a bad thing. Almost every other firm does that. But not being able to generate enough wealth to pay off. The liabilities surely damage a company's PR in the business industry. And because of this, other companies feel reluctant and hesitant in doing business with that particular firm. This damages the company on an external level and makes it even more difficult for them to do business. This causes hurdles in generating wealth, and the company further dwells into bankruptcy. There is no end to it until a company sells its assets in order to accumulate enough cash to pay off its debt. Liabilities are usually debts settled over a course of time between firms through the transfer of economic benefits, such as money or certain services that a company provides to other firms that it owes. In financial accounting, companies book liabilities in opposition to assets, with the current liabilities being a firm's short-term debt that they have to pay within the span of almost 1 year or in a normal operating cycle. Long-term liabilities, also referred to as non-current liabilities, are considered as the long-term financial obligation that a company has to pay in the span of more than 1 year. When a company fails to settle down its liabilities in the limited amount of time, then it has to face certain consequences, like to sell its assets in order to pay off the remaining debts, sell its shares, or even pay off a certain amount of penalty in addition with the total debt. This surely puts a dent on the company's financial structure and makes it even more difficult to recover from the loss. That's why it is more than necessary for a company to settle its liabilities in the due time. Dragging things any further may cause harm to the company, and it won't prove to be beneficial in the long run. Moreover, the mutual cooperation between the two firms would be seriously disrupted by this. When a company sells its assets to pay off its obligations and settle its liabilities, it doesn't give a good impression to other firms who are willing to do business with it. Therefore, certain actions have to be made and strict measures have to be taken in order to save the company from getting default. That's it for today's video. Thank you for watching it till the end. We hope you would like it. If you think that we have missed something, then make sure to list them down below in the comments section. We would be more than pleased to read them.